Hello everyone, welcome back. In today's market update, we'll review what happened last week, highlight key macro drivers, break down market performance, cover the big corporate movers, and what to watch closely next week. We'll also talk about which stocks are setting up for potential long and short trades. If you enjoy this content, don't forget to like and subscribe. Let's get started. Before I get going, I'll just give the disclaimer now that I'm not a financial advisor and these are not buy or sell recommendations. Everything that I'm going to talk about is for educational and informational purposes only. Let's break down last week's inflation readings and what they mean. First up, the Consumer Price Index or CPI. In August, CPI rose about 2.9% year over year, slightly higher than July's 2.7%. Now, if we strip out food and energy, the so-called core CPI that stayed steady at 3.1%, next, the Producer Price Index or PPI, which tracks wholesale inflation, that number actually cooled down, showing prices are easing earlier in the supply chain before they even reach consumers. That's a positive sign. But it's not all smooth sailing. Tariffs are still creating cost pressures, especially on imported goods. Some of that is already being passed on to consumers, and that's something economists are keeping a close eye on. So overall, CPI ticked up a bit, wholesale inflation is cooling, but tariffs remain a wild card. Now let's talk about Fed rate cut expectations. Markets are increasingly betting that the Federal Reserve will cut interest rates by 25 basis points this September. There's even a small chance being priced in for a larger cut. We're already seeing the impact in the bond market. Treasury yields have dropped, especially on longer-term bonds, as investors position ahead of that potential Fed move. So in short, Wall Street is leaning toward a September cut, and the bond market is confirming that shift in expectations. On the equity side, it was another milestone week. The major US indices, the S&P 500, the Dow, and the Nasdaq all hit fresh intraday and closing highs. What's fueling the rally? A mix of AI optimism, strong earnings from big tech, and momentum in growth stocks continues to push markets higher. So, between the Fed outlook, easing inflation trends, and tech leadership, stocks are powering into record territory. Let's move over to corporate earnings, specifically Oracle. Oracle reported results that really stood out, driven by surging demand in AI-related cloud services. The company secured a wave of new AI cloud contracts, which not only boosted this quarter's numbers, but also signaled very strong future demand. Why does this matter? Because AI workloads require massive amounts of cloud infrastructure, and Oracle is positioning itself as a major provider in that space. With partnerships expanding and enterprise adoption of AI accelerating, these contracts suggest Oracle's cloud business has plenty of runway ahead. Let's move on to Tesla, which just staged a powerful breakout. The stock cleared key resistance in the 356 to 360 range, and once it pushed through, momentum really picked up. Volume surged above that level, suggesting institutional buying was behind the move. Right now, traders are eyeing the $400 level in the short term, and some longer-term bulls even see potential toward $800 if Tesla's next big vision plays out. That vision is the much-talked-about robotaxi model. Elon Musk is pushing the idea of turning Tesla into more than just a car company, shifting away from traditional dealer sales toward autonomous subscription fleets deployed directly in cities. If that vision becomes reality, it could transform Tesla's revenue model and justify the bigger price targets investors are speculating about. The big event on deck is the Federal Reserve meeting September 16th and 17th. Markets are widely expecting a 25 basis point rate cut, and that's already priced in through FedWatch and most forecasts. But it's not just the cut itself that matters, it's the tone of the statement, the dot plot, and Powell's press conference. Are they more hawkish or more dovish? That's what will set the tone for the next several weeks. Traders need to pay very close attention to that 30 to 90 minute window right after the release. That's usually when the next directional bias is established. If you're holding stretch positions into strength, consider trimming and keep risk management tight on names that have already run up big. We may get a minor pullback after the rate cut, some sideways chop, and then to move higher resumes into new highs. Bottom line, next week is all about the Fed. Their tone and Powell's words will be the roadmap for how equities, crypto, and risk assets trade into Q4. That's it for now. Catch you next week with another market update. Here's what's setting up well for the week ahead.